Good morning. It's Monday, the 26th of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The take: how the gap between private and government jobs is increasing. Close to 5 million people earlier this year applied for about 60,000 jobs in the Uttar Pradesh police. The Karnataka Examinations Authority in the state of Karnataka received around 500,000 or 500,000 applicants for a 1,000 job position for village administrators, according to a local news portal, News Karnataka. Now, these figures may not be fully accurate, but looking at the number of similar examples we keep hearing periodically of, massive numbers of people are obviously applying and are physically landing up in many cases, and further even risking life almost and limb for these government jobs. So the truth cannot be too far or could be worse. So the central government has now approved a new unified pension scheme which is expected to benefit around 2.3 million government employees and will also serve as an alternative to an existing national pension scheme. Now, there are several aspects to this new pension scheme which assures pension post-retiring, the best case being a qualifying service of 25 years, after which the pension would amount to 50% of the basic salary drawn for the past 12 months, plus dearness allowance. So I'm not getting into more details, for example, the assured pension or on demise and so on, because you can find them quite easily. Because what is important is this: the perception of government jobs as a means of safety and security over the long term will only increase and thus amplify the disparity that already exists in the minds of young Indians. A driver who worked with me a few years ago said he was leaving me because he was applying to a government job involving driving a truck in conditions which sounded pretty harsh. He admitted the salary was actually lower, but he said that this would be made up over time and he would get long-term job security and medical benefits for his family. He had even paid off some agent to help, as I could see. I wished him all the best, and as it happened, ran into him a few years later, and all of this is still before COVID. When asked how his government job was going, he said he did not get it and was actually cheated by someone. And he was back to working with some family. The latest unified pension scheme only increases this perception of job security with government, which is that there is more job security with government. Some people will say that taxpayer money is increasingly funding government employees who don't deliver their best services to us. Be that as it may, the larger problem also is that the private sector will not and cannot keep up to the promise and challenge of job creation, at least at the level required. Last week, the IMF's first Deputy Managing Director, Geeta Gopinath, said India needs to create between 10 and 24 million jobs annually in the next 5 to 6 years. The government's own chief economic advisor has said 8 million jobs last month. Now, contrast all these figures with the need, or rather the availability, of government jobs. Now, the government, by offering better pension schemes, which also it may not have a choice about, is increasing that gap, as I said earlier, between the uncertain private jobs and the certain government jobs. The larger problem is that the government jobs do promise a certainty which they should not in this era. A government job may offer relatively more security, but it cannot be that once in you remain for life and only lose out when caught out committing a crime or such. There are, of course, options for pension contributions in the private sector too, but that's only for a handful of well-paid, organized sector jobs, which is perhaps only around 7% or so of all jobs. And none of them will pan out the same way. Ask me, I'm the child of a public sector employee, and I marvel at the perks that my parents were entitled to even after retirement and until death, which I cannot even dream of. Either way, in this day and age, as a private sector person, it's my job to figure out whether through smart investing or appropriate life insurance and health insurance schemes till death. But most unorganized sector workers, despite some of the newer savings and insurance options available, can barely expect that same level of security and safety of government jobs as we know them today. So, even if they work in the unorganized sector, they will always aspire for a government job. One reason why unemployment levels stay higher for longer among young people is because they're going after government jobs year after year, including the most desired, the Indian Administrative Service, which in turn drives a thriving industry of predatory coaching classes which prey on insecure parents and their children. More on India's jobs challenge with my guest Shankkar Aiyar shortly, but this is a problem that needs to be attacked at various levels, but we must also work towards making government jobs less secure and thus creating more balance in the jobs market. I know it sounds counterintuitive, but in that process, we can actually pay government employees more and thus better link productivity and performance. Now, none of these ideas are brand new, but the time to do so or do something has come. Creating more disparities and asymmetries in the job market is dangerous. The new pension scheme will make government employees potentially happy, but it will create much more discontent elsewhere. And that brings us to the top stories and takes. The stock market see the longest rally of 2024 and now braced for opening of the sluice gates. Why is the government not being as strident about quick commerce while attacking the Amazons of the world? Silver imports are set to zoom even as industrial and personal application demand increases. Sebi cracks down on Anil Ambani but not other agencies. The government's job conundrum and the way forward.
This is a core report with Govindraj Ethiraj.
The markets stay on course. Indian stock markets rose for the seventh straight session on Friday, the longest rally now this year, though the euphoria, if so, was muted as all eyes now turn to the Federal Reserve and its September moves, and more on that shortly. The benchmark indices, Sensex and Nifty, ended Friday's mostly flat trading session, only slightly higher as investors were looking out for clues of possible interest rate cuts by the Federal Reserve. At closing, the BSE Sensex was up 33 points to 81,086, while the broader Nifty 50 was up 11 points. That's really marginal at 24,823. Now, the Federal Reserve Chair Jerome Powell's widely anticipated speech confirmed expectations for an interest rate cut at the central bank's next gathering on September 17th and 18th, which in turn pushed up stock prices and treasuries, according to Bloomberg. Powell said on Friday that the time had come for policy to adjust and the direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. And of course, while everyone is watching the Federal Reserve, other central banks are also indicating a lowering of rates. Bank of England Governor Andrew Bailey said on Friday, quoted Bloomberg, that while it was too early to declare victory over inflation, the risks of persistent price pressures appeared to be receding. So the UK Central Bank had already lowered its benchmark interest rate earlier this month, while several members of the European Central Bank's Governing Council present at that same conference said they would support another reduction in interest rates next month. So the ECB had lowered borrowing costs in June, and they said that a decision to ease in less than 3 weeks was easy given the data on inflation and growth. Silver imports set to rise. So in commodities, something we've been discussing here for some time, consumption of silver is set to shoot up as people will buy or are set to buy more for both industrial and non-industrial purposes, or things like jewelry. India's silver imports are on course to nearly double this year, says Reuters, due to rising demand from solar panel and electronics makers, even as investors bet that silver could give better returns than gold. Reuters quoted importers saying, India has already imported about 3,600 tons of silver last year, and there is a general feeling amongst commodity experts, including the core report has spoken to in recent months, that silver has turned out to be a good investment purchase with, like I said, the ability to deliver similar or maybe even better returns than gold. Prices for silver, by the way, are already quoting at a decadal high. Now, this year's purchases for silver could rise to between 6,500 and 7,000 tons thanks to that rising industrial demand, a silver importer told Reuters. India imported around 4,500 tons of silver in the first half of this year compared to just 560 tons a year ago, according to data quoted by Reuters. Sebi cracks down on Anil Ambani. India's markets regulator, the Securities and Exchange Board of India, on Thursday banned Anil Ambani, brother of Mukesh Ambani, chairman of Reliance Industries, and 24 others from the securities markets for 5 years on charges of diversion of funds. Prior to a messy split up in 2005, or almost 20 years ago, the two brothers were in the same company, which is parent Reliance Industries. Anil Ambani split and left with several companies, including in power, telecom, finance, and entertainment, almost all of which are now wound down, including the company in question. The Sebi also imposed a fine of 25 crore rupees on Ambani, saying he orchestrated a scheme to siphon off funds from Reliance Home Finance, a listed subsidiary of conglomerate Reliance Group, of which he is the chairman, according to Reuters. Reliance Home Finance was in insolvency and then bought by another company. Now, this ban means that Ambani and others cannot access the securities market, but the regulator charged Anil Ambani on two grounds: diversion of substantial funds of the company to the detriment of the company and its stakeholders. It also said that more than 9,000 crores worth of loans from Reliance Home Finance were made to nondescript borrowers who had no demonstrable financial ability to repay any of it, and another 5,000 crores worth of loans were granted to entities connected to the promoters of the Reliance Group. And it further said that the facts of this case were particularly disturbing since it reveals a complete breakdown of governance in a large listed company apparently orchestrated by and or at the behest of the promoter, aided by the indigent management of the company, according to Sebi. So the interesting thing here is that the case is being handled as a securities industry problem, which is by Sebi, and not a banking industry one, which is, for example, involving the Reserve Bank of India, presumably because the funds are shareholder funds and not borrowed from banks, or as I can see at this time. Now, if bank money was involved, then this ought to or should be a case involving the Indian Penal Code and therefore criminal proceedings. Why is the government not so strident on quick commerce? India's trade minister the other day fired a fresh salvo at Amazon, repeating what he said 4 years ago and words to the effect that they were bringing in investment but only to fund their losses. Not only that, he wondered about the social impact of e-commerce. All this he did it at an event to release a report that ostensibly talked about how e-commerce had actually created jobs and opportunities for small businesses. And that report was prepared by a non-profit foundation, which was actually pretty government-friendly. Interestingly, the trade minister seems to have taken a step or two back after that statement in a subsequent event, but some of his points are actually valid and are definitely worth discussion. For instance, the fact that foreign e-commerce companies cannot own inventories of the product they sell. Well, they don't, at least technically it would appear, though to a consumer, it's obviously all seamless. But the same logic actually applies to quick commerce companies. The only difference here I can see is e-commerce companies like Amazon and Flipkart, owned by Walmart, are foreign or American companies in this case, with Indian subsidiaries, while the quick commerce companies are much feted Indian startup founders, but with almost entirely foreign capital. The distinction of attacking one while staying silent on the other one is not a fair one, I would think, if we were to draw a distinction. Because if you take away the Silicon Valley type venture capital, which is funding these quick commerce companies, which deliver to you in 20 minutes or 10 minutes or whatever, their ability to do reckless discounting would disappear pretty much overnight. Because quick commerce, which in many ways is a bigger threat to precisely this constituency that arguably matters more politically. And quite simply, quick commerce operations at scale have a direct impact on small shops and kirana stores much more than Amazon does, at least the way I see it. Now, how much and why is something we'll come to shortly. So the latest development is that the FMCG, or Fast Moving Consumer Goods Distributors Association, has written to the Ministry of Commerce and Industry expressing its apprehensions that the unchecked expansion of quick commerce platforms was leading to severe disruptions in the retail ecosystem. The All India Consumer Products Distributors Federation on Thursday wrote to the government saying that significant challenges were posed by the rapid growth of quick e-commerce platforms to the traditional retail sector and the FMCG distribution network in the country. They said that they acknowledge the role of innovation and technology in shaping the future of commerce, but the unchecked expansion of these platforms is leading to severe disruptions. The association said that India's foreign direct investment regulations clearly prohibit e-commerce entities operating under the marketplace model from holding inventory or exercising control over inventory sold on their platforms. However, it appears that these quick commerce platforms may be engaging in practices that blur the lines between a marketplace and an inventory-based model, potentially violating FDI norms. The association also asked the government to initiate an investigation into the operational model of these quick commerce platforms so as to ensure compliance with FDI norms and implement measures for small retailers and traditional distributors. I reached out to Dhairyashil Patil, the Kolhapur-based president of the All India Consumer Products Distributors Federation, and I began by asking him why the federation had written this letter now to the Trade Ministry.
The basic reason to send this letter to the Ministry of Commerce is now discount war has been begun yet. We were silent since last 2-3 years after the release of press note. But with the entry of quick commerce, the race to gain pace in the market has again started. And the easiest way in is to give more and more discounts on the products, which is not realistic, which is harming the entire ecosystem as the retailers.
How are you distinguishing between e-commerce and quick commerce?
It is just a terminology. E-commerce and quick commerce is just the same. Now, if you see the players like Flipkart and Amazon are trying to gain on quick commerce as well. Quick commerce is nothing but just expediting or reducing the delivery time. Rest of the operation is mostly the same. Because in e-commerce, a normal delivery is from 3 days to 7 working days. And in quick commerce, the delivery is from, say, about 10 to 20 minutes. For us, it is not different. The modus operandi of both is mostly the same of predatory pricing and deep discounting.
But your focus at this time is the quick commerce companies.
Yes, because we believe that in India, we have a e-commerce model where inventory is not permitted by the norms of FDA. So herein we see that the dark stores which have been built under the name of quick commerce to supply and replenish the entire inventory, which is entirely under the control of the quick commerce company. The thin line between the rule and whatever is happening seems to be a bit dicey for us.
Right. What do you feel is the way forward?
We have requested the minister to look into this matter. And we have gone through some reports since yesterday after our meet has been reached to the ministry that quick commerce is pretty small and it is not yet to be under any regulation. But we hardly see any difference between e-commerce and quick commerce. So we want the government to act as swiftly as it can because the damage has been already done by the e-commerce to the entire ecosystem of about 8 crore traders. And we have seen the way things have happened in past. But this quick commerce development would bring the end of very nearer. As the competition is going steeper, you've seen players like Flipkart has just launched in August which is giving discounts more than whatever was offered by other players, 10% more. So this is a never-ending story and it is going to be very lethal once it progresses. So it is better to have an early check on this quick commerce to protect the entire retail trade because we are having approximately about 1.5 crore pops and mops kirana stores which are directly affected by this quick commerce. Particularly in quick commerce, three things are being concentrated by these companies. One is grocery, the second one is FMCG, and third one is vegetables, which are presently done by all these pops and mom stores are directly being affected.
You said that at this point, the size of the threat is not much. Also, because obviously there is a large amount of discounting that's going on and that cannot be sustained. Do you feel that in coming months, the quick commerce companies will also be forced to reduce their discounts, levy, let's say, a delivery charge or a higher delivery charge, and that might equalize things?
We firstly want the government to look into the operations of this thing because we feel that the law is not being followed in the letter and spirit. Where inventory based e commerce is prohibited by the government organizations under FDI rules, where you cannot have a control or entire monopoly over the inventory what you are carrying. And it seems that under dark stores, this has been happening. So this is just a new name for an old business. So it is e-commerce and extension with quick commerce. Players are almost the same. And the amount of money flowing in right now is a pretty alarming situation. As the Honorable Minister has said, the money which has come in is not a part of investment, it is just the debt service, where it is not going to generate any more jobs, neither it is going to have any more infrastructure. It is just servicing their debt which they have lost in the last year. So bringing in the show which has made by all these companies that there are a lot of investments coming, that is not going to help our country or the trades.
Right. We are now into the second quarter, Dhairyashil. How are things looking overall for in terms of consumer demand just ahead of festival season?
See, as you have seen, the first quarter was not that encouraging for the entire FMCG segment. But we are very much hopeful that this being festive season, that we will have a normal festive season. We just have past Raksha Bandhan. We have Ganpati and Diwali in upcoming quarter. So we are very optimistic that we would do good sales in this. But as I've said, things are not pretty encouraging at the end of consumer offtake. consumer aspect still is a bit sluggish.
Right, Dhairyashil. Thank you so much for joining me. The big jobs question. So we discussed India's jobs conundrum earlier. The big question is, of course, the big gap between job demand and supply, which is not likely to get better. So the government, to its credit, has been trying different things, including the most recent being the announcement of an internship program, the design of which is awaited, apart from incentives and income support for new jobs created by industry. So I reached out to veteran economic journalist and author Shankkar Aiyar, and I began by asking him, what does this new pension scheme reflect in the context of the larger economic and jobs challenge in India?
For all governments, sort of they wrestle with the idea that there are two constituencies. One, there is a political constituency, and then there is the economic constituency. The government's earlier concern in the economic constituency was about pension costs and stuff like that, and the layering of liabilities on the future. The political constituency has spoken in the past few elections, so the government has made some adjustments. So this solution actually falls in the overlap of the political constituency and the economic constituency, in the sense that it could satisfy both the users in the government and also the folks who are concerned about liabilities. So I believe that the solution between the new pension scheme and the old pension scheme was originally scripted in Andhra Pradesh. And so they have there has been some drip irrigation or lift irrigation, as we may call it, by the government of India.
Right. Now, while these, let's say, government employees will be now better positioned and will obviously have reason to feel a little more secure than they were earlier for their future, what does this mean for the rest of the economy?
Well, this will once again underline the advantage of being in a salaried government job. And so the pressure that you witness whenever new posts are announced or tests happening will sort of be amplified. Historically, families which have had a government job have had a more secure future because there is predictability and there is also the inflation adjustment that you get in the DA and other stuff. Which is why I think even in rural India, it is a very priced thing. If you had a government job, you get the better bride, better house, better everything. So the worry is that there is so much dependence on this kind of government jobs, and that dependence comes from the fact that not enough jobs are being created in the hinterland by the private sector. If you look at it, I mean, it's not that the government hasn't thought about it. If you remember, Prime Minister Modi, when he came to power 10 years back, spoke about India being the manpower solution for the world. And so there was a report written on global opportunities. At that point, there was an attempt to sort of take that idea forward. And in recent years, you would have seen some agreements with Israel or with Japan on other countries on labor contracts. But there is also the other aspect. Every state, now let me put this in two buckets. There is the global opportunity and then there is the local opportunity. And the local opportunity should be measured whether it's happening or not. Every state has some kind of investment thing, magnetic, Maharashtra, kinetic, Karnataka, whatever happens, and there is no review of it. And the ideal institution to do these kind of reviews, whether those investment conferences lead to investments and whether those investments are creating jobs. It is not enough to depend on PLIs. So the Niti Aayog is best placed to sort of study these, understand this, and advise governments. The other way to look at is where are the jobs being created? Say Tamil Nadu. What is Tamil Nadu doing that is so good that is happening? Or why are more jobs now being created in Odisha in the last 5 years? So those best practices need to be shared. I think there is surfeit of information and vacuum of knowledge in the government.
Okay. So you've already sort of touched upon the point of the larger jobs challenge and how we can or cannot. But at this point of time where we are, now that one, let's say, segment of the populace has been given a gift of sorts, what should the government be doing or what should be the way forward?
Let's arrange the facts. So you have a report about global opportunities. You have some understanding about the skill sets. You have some knowledge about how much skill training has happened and the challenges of placement. And those who sort of designed the internship in private sector program would have had some database. Now, if you align all of these database, you know that you need to create X number of jobs and only X minus whatever is being created. The other challenge is that as geopolitics unravels across the world and disruptions unravel, the ability of the Indian economy to support jobs will be challenged, whether it is in those who are, for instance, you have to move to the net zero or, no new fossil fuel idea. And that will challenge job creation in the fossil fuel economy. There is also the challenge of AI. There is the challenge of AI assisted healthcare. In the US, for instance, what is happening to retail and fast food companies, because of the weight loss drug, similar things will arrive in India. I think that there is an understanding that these jobs has a political implication, but I don't think the government has paid sufficient attention as to how to process this information on a monthly basis. So if you look at all the information, what are the missing opportunities, where the government can move in, they can do that. And instead of sort of going blue in the face, denying that there is joblessness or there is job growth or there is underemployment, I would think that let's try where the issue is and address those issues. I mean, already if you see this year, growth will be not as robust as last year, which has consequences for job creation. Global growth will be lower, which has consequences for the IT sector, which is the largest employer. I would suggest that the government should have like an interstate council which meets every month and discusses what's happening to the economy and thereby the job creation.
Right, Shankkar, thank you so much for joining me.
Thank you, Govind.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.